Hi and welcome to the Financial Fox. I hope you are all keeping safe and you are well. I'm kind of okay. My family is not. Obviously, they've been through little chaos in Italy, and they are a little bit struggling. But hey, we are gonna go over this all together. So let's stay positive. Now, today is another video about the investment and the financial crisis and how the coronavirus is impacting the market, but is also creating opportunities. My guest is Amanda van Dyke. She's a fund manager at South River in London, and she's also a well-known gold and mining expert. What I'm going to talk with her about will be mainly how the coronavirus and the financial crisis has impacted the commodity sector and also has created a very big volatility within all asset classes, including gold, which has always been considered a safe haven asset. But this is not the only thing, because obviously the crisis and the market is kind of recovering. So we have to look at what are the opportunities out there within as investing in gold. So gold as a commodity, gold as an equity, but also we have to look at the battery metals, which are going to be much more important as we get out of this crisis, particularly for technologies, and also the oil market that has been affected by the war between Saudi and Russia, and a very worrying low oil price that affected all oil producers. But even here, there are still opportunities. So let's connect to Amanda to get a little bit more insight into the commodity and resource space and identify which could be a good opportunity for investors to reposition their portfolio and get ready to reinvest their money as the market is recovering. Hi, Amanda, how are you?
Hi, I'm really well. It's really nice to see someone else when we're all sort of stuck in our
Exactly. At least we have got, the technology that allows, to speak. Anyway, are you keeping well?
Yeah, I am. I'm being surprisingly efficient from home.
That's really good news. Well, maybe this situation is going to change quite substantially the way that we actually behave, and all the kind of society and economy as well. It's going to have a big impact also in changing behaviors. What do you think?
I think that there's going to be a lot of changes. We can't know all of them right now. I think look, this market correction was long overdue. But I think there are good things to come out of coronavirus. One, they've made working from home a whole new world, and people have realized you can be productive from home, and it'll allow remote working and more working together from all over the world, which is a nice benefit. Exactly. I think it's making our sense of community and our commitment to both our own people, our nation states, and our economies more important. Like, people realize how interconnected everything is and how much we depend on the economy. So I think you'll see a much more aware population in terms of their decision making going forward. But crises happen, and we'll get over this crisis like we get over every crisis.
Amanda, let's talk a little bit about the market, which is what our viewers are interested in. You are a fund manager at South River, and you are a gold mining expert. Now, my main question was coming from a reflection that usually in time of crisis and market crash, we always see some kind of safe haven assets, and gold has always been one of those, with bond, for example. And actually in this crisis, we have seen quite volatility also in gold, silver, and obviously also in bond. How different has been this crisis, and why do you think gold hasn't kept its kind of value as a safe haven asset?
Well, I don't think that's quite fair. Gold took a short-term dip, like a week, 10-day dip. First, it rallied. When we started going into this crisis, gold was rallying and continued to rally. But when the Fed cut rates, or the central banks around the world cut rates, and there was considerable discomfort about the markets, everybody was selling everything, and gold equities were in everybody's portfolio. So they got sold with, in a sell-off, gold always goes down with everything. That's every single, while it is a safe haven asset, you're looking at a very short-term time. So it went down for 10 days, but it and the American dollar, another safe haven, went up, which is a negative correlation to gold. But nonetheless, it came back about 10 days later. It's trading high again today. It's trading at reasonably high rates compared to the rest of the world. And I think it'll continue to do well. So the short-term sell-off in gold is now over.
Now, you mentioned about gold and then gold equities. Do you maybe want to comment on that and how the correlation is?
Yeah, so gold is the commodity if you're buying it. Most people buy it in an ETF, a bullion ETF of some sort. It's the easiest way for investors to get access to pure gold. And gold rallies before gold equities do. But equities, even baskets of equities, sit in people's portfolios as one of their assets. And when you have margin calls, when the whole market is going down, there's an automatic selling of equity assets, which is why gold equities go down, and it could take slightly longer to recover because people don't have the cash to come in. So on the whole, gold and gold equities go down with a crash with everything else. Gold recovers first, which it's already started to do. And then gold equities recover quickly on its back. So within the next month, I would say gold equities will be reflecting the new gold price.
So do you think now is a good time to buy gold?
Yeah, I think it's an excellent time to buy gold, to be honest. Gold is a safe haven asset, and in the medium term, gold is strong. The strongest correlation to gold is real rates of return. And given how governments around the world have cut their central bank rates, like the Federal Reserve and the Central Bank of England and all of that sort of stuff, that means the real rates of return, assuming we get some recovery, are negative. And given that real rates of return are negative, that's an excellent environment for gold. It's very similar to the financial crisis in terms of rates and how gold performs in that period. Gold rallied to $1,900 an ounce during the last financial crisis. I don't think that's that unreasonable in this financial crisis either.
Okay, talking about gold equities and companies, what I would like you maybe to give us some guideline, let's say, or at least your criteria in assessing a good investment in a gold, in a company that is producing or exploring gold. I mean, we see, for example, on AIM, there are many mining companies involved with gold as well. But there isn't a strong fundamental behind the company. That's probably a company that is not going to survive this market crash. Which are the criteria that makes a good investment in gold equities?
It's a very long discussion, longer than we have today, to talk about a good gold equity investment. What I can do is what you said about which sector. As I said, gold rallies first in a crisis, gold, the metal. Second, in about a month, you're going to see a significant rally that's already slightly begun in gold producers. So in a crisis, when people want gold, they want the guys actually producing gold, not the guys that need to go find gold, explorers, or developers that need a lot of cash to finish doing what they're doing, although most of them would be funded right now. So in the first instance, if I was buying today, I would be buying gold equities. I think that's your best scenario investment. And gold producing equities, a producer index, that sort of thing. In a few months, when it looks like, assuming this is going to be just a recession and not a depression and coronavirus passes, then I would start looking at gold developers again. And once the price of gold reaches its zenith in a year or so, then I would be looking at gold explorers as well.
Okay, Amanda, do you have any company that you would like maybe to highlight to investors, whatever they are, FTSE 100, FTSE 250, or even small company that you like?
it's hard to give recommendations on individual companies without sort of doing their up-to-date work and looking at where they are, because all of them will go through this crisis slightly differently. So I'd like to sort of not give specific information. What I would say is buying an index right now is not a bad thing. So buying a producers index versus an AIM gold index or something like that would be a very good place to be. And I would make sure you were buying a gold index, not a gold and commodities index, which is a lot of what those indexes are. There are a few staples that I've always loved. I mean, Sentiment is a great producer at a great price, always to be sort of respected and liked. Endeavour Mining and B2 Gold, Canadian stocks, but still very, very good in the producers index. And those would be sort of, and then there's the big guys on FTSE, which are just excellent. I think Fresnillo, Polymetal, Highland Gold, those would all be really good producers to be in right now if you don't just want to buy a basket ETF full of producers.
Okay, thank you so much for the insight. Now, looking at another side of the mining sector, I just wanted to touch the battery metals, for example, lithium, nickel, cobalt. They have been growing quite a lot over the last couple of years. How do you think the coronavirus and this market situation is going to impact them?
I think you need to look at base metals and battery metals in the same basket. When we go into a recession like this one, and this is going to be a recession no matter what, and we're hoping it's not going to be a depression, people buy less stuff. And especially in this particular crisis, people have turned off their factories, and the factories that use the metal to build things are closed. The people that work at those factories are gone. Therefore, commodities are going to take a serious hit like they have. And base metals and technology as well. Gold demand is based on its demand as a safe haven, which is why it goes first in a crisis. That's why this is where you want to be right now. People won't start buying commodities again until the factories are turned back on and they see green shoots that we're coming out of a recession. So that when they see a positive future, like once we've hit bottom and we start going up again, that's when you want to pile into commodities and sort of mining producers and mining developers. So I think we have some time before we see when the end of this recession is going to be, but it's something you need to watch very carefully, because in the years post a recession or a crisis, a year on usually, suddenly commodities will start shooting the light outs and they'll be the best performing asset class while we're coming out of a recession. Because
exactly. Because also some, as you mentioned, the battery metals, for example, I mean, most of these materials, they are used, for example, in smartphone and electrics and anything that consumer good that we actually need quite a lot, particularly for example, for this kind of new communication.
I agree. And so there's a two-part answer to that. In the short term, look, there's a lot of people who are just out of work. And in a recession, everybody's portfolios, everybody's assets, everybody's jobs just got slashed. So the amount of money they have to buy new technology isn't going to be that high. It'll start getting better when the economy starts to recover. I do think that you make a very good point that coronavirus has brought home to us the importance of technology in keeping the world going, especially in a crisis. And there is people don't tend to correlate these things, but technology is intrinsically related to the metals and mining industry. Every bit of technology we have is metal intensive, and not just one or two metals, like 50 metals. There's like 100 different metals in your smartphone. So I do think in the sort of medium to long term, coronavirus and coming out of this financial crisis, which are two different things, is going to do impact very well upon the desire for technology and the importance of technology in the modern world, and metals and mining and their contribution to that technology. So they're both sectors that I think will do very well. I just think in the short term, while we're in a recession and while we're in a downturn that nobody quite sees the end of yet, there isn't extra money for more technology. Let's be realistic. All of the computer stores are closed. All of the phone stores are closed. So in the short term, it won't help. In the medium to long term, you're correct. Coronavirus and a financial crisis are going to make technology and metals and mining that goes into technology even more important than it was before.
And also, do you think that this kind of situation is going also to change the power of the main consumer of mining products? For example, I'm thinking about China. Where do you see China? How do you see China coming out of this economic downturn, and also their position, their power within the mining industry?
Look, China, like every other country in the world, is going to experience an economic downturn and potentially a recession based on this downturn. They had to close down first. They're a month or so ahead of the rest of the world, but realistically, this is going to seriously hurt them. They had to close all their factories that were consuming those mining and metals as well. But on the other hand, everything about China is about numbers. China had 500 million people that were working from home, connected by technology. That there's been no financial crisis in history, no war, no anything that's allowed that many people to be connected. And that was all based on technology. And China is a very technology intensive country. So I think that they're going to rely even more on technology, and they've realized the importance of their technological networks if they didn't already, and that'll continue to be very important. You might see from them a bit more stockpiling of commodities. I'm not sure, in case another crisis like this happens, because let's be realistic, one coronavirus can lead to another coronavirus. So you might see them stockpiling a bit more to be safe, but yeah, I mean, I think they're going to be in the same position as the rest of the world, which is a renewed investment in technology to make their economies be able to run during these types of crises. But on the other hand, they've taken a significant financial hit by closing down all their factories and having people out of work for 6 weeks. So restarting that and trying to get everything going again is going to be difficult as well as expensive. And for the short term, they're not going to be throwing their money into commodities. They're going to be throwing their money into recovering their economy the way that Western world governments have. What's really interesting about this crisis is it's really sort of leveled out emerging markets, China, and the rest of the world, and shown us that China is really in the same position we all are.
Exactly, and also the US is kind of, I'm not saying losing power, but is basically facing a situation that very challenging for them as well.
It's challenging for everyone, and we're all in the same boat. And it also shows you that China has really crossed. We used to refer to, and I think officially it's still referred to, China is referred to as a developing market. I think it's time we're going to start realizing that China is a developed market that has all the same problems that other developed markets do, and all the same benefits that other developed markets do, like the fact that 500 million people had enough technology in their homes to be able to work from home. That is very impressive.
Yeah, this is really, really impressive. Now, we talk about the commodity and the mining sector. I actually wanted to dig deeper in the oil and energy sector, where we are seeing another, let's say, crisis with very low oil price that has been really challenging for many oil and gas companies, including the producers as well. Do you think that this coronavirus is going to push for a new deal between Saudi Arabia and Russia in the next couple of months?
I'm not sure, to be honest. Saudi Arabia and Russia have been unhappy, both sit at the OPEC table, and they haven't been very happy with each other. They both have very different interests and different allies in the world. And the fact that this fight between them and their different interests came to a head right before coronavirus is a little unfortunate. But it might be fortunate for the rest of the world, because the fact that coronavirus hit, which means people are consuming far, far less oil right when they were having a bit of a price war, has kind of put them back in their box. And realistically, with oil prices down where they are, and oil companies not with low oil prices as well as low oil compounded with low oil and gas demand, that really means that the oil companies are going to be seriously hurting, and that seriously affects Saudi Arabia and Russia, who directly benefit from ownership in their large national oil companies. I think that they're going to decide, like, in the interests of pragmatism, they're just going to say, enough already. Okay, we were going to have a fight. We're going to have to put this off until a later date. I think you'll see them coming back to the table and working together, not because they want to, but because they really have no choice. They will sort out their issues quickly in the interests of trying to get the oil price back to someplace sustainable. The oil price will recover when the economy recovers faster than the oil companies, who had low oil demand as well as a low oil price to contend with, and also likely had a lot of debt, and that debt right now is going to be hurt. They're going to have trouble servicing that debt. So, but despite that, I don't know that I wouldn't necessarily consider investing in oil companies. And a lot of them, like BP, have recovered in the last few days considerably. And that's because that's mostly in the price. Like, the low oil price and low oil demand has been hit in the prices of oil producers massively. And I don't know that they wouldn't necessarily be a good investment. I need to restate that. I think they could be actually a good investment right now, because while they are in trouble, their stock prices have been hit harder than is reasonable.
Yeah. For example, even looking at BP and Shell, I mean, they went down so much that we have just started to see some kind of recovery, really.
So if you're just playing the price, I think while there's no question that a low oil price and low oil demand is going to be very hard on those companies, I think that potentially some of those companies are oversold, and there's still good value in them. You need to do your homework and decide what is the right value. Understanding, of course, that their demand and their price is going to be low for the short term.
You did mention about gold producer. They will probably be one of the best investment as the market is recovering. Do you have any advice or opinion regarding oil or gas energy company, let's say?
Well, once again, very similar to gold, you're going to want to go for large producers first. And that's because there's three things. So a low oil price as well as low oil demand, combined with the fact that they have a lot of debt, that's going to hurt the smaller producers more than the larger producers. The larger producers are in a position to renegotiate their debt covenants more so than smaller producers, which could make those companies more stable and a better or a safer investment early on. As things recover and as you see the oil price recovering, that's when you want to go into the smaller producers.
One of the things that it might happen is that we maybe have reached that tipping point where oil is going to become less important in our economy and society, and we will see an increase on renewable energy that was already kind of picking up before then, mainly because of this climate change and everything. Do you think this is kind of the trend that we are moving towards?
Look, in terms of our energy basket, we are moving away from fossil fuels and into renewable energy as much as we possibly can. But there's only so fast we can do that. And on one hand, energy metals, like metals that go into electric and renewable energy, are a great investment right now. But the reality is the market's already priced in how much we can replace renewable energy with. It doesn't happen overnight. I think the whole world has basically accepted that we would like to move as much towards renewable energy sources as we possibly can. But there's a sort of natural pushback to how much we can depend on renewable energy sources and how quickly we can convert to that. It takes a long time to put up windmills and solar panels and to create those sorts of things. And realistically, there's only so much space in the world for windmills and solar panels and nuclear power plants. And they take a very long time to permit, construct, build, and put into place. So while I think in the long term, and I'm talking 10, 20, 30 years, you're going to see a slow phasing out of oil as much as and fossil fuels as much as we possibly can. I think that the pace of that replacement is going to be a lot slower than a lot of people think, just because of the practical pushback on how fast we can actually convert to renewables.
Amanda, if you have to kind of advise on an investment, a good and balanced investment portfolio within the natural resource space, what will be your advice in terms of cash reserves, in terms of investment in gold, investment in battery metals, oil and gas? How would you advise on the kind of ratio between the different exposure to resources investment?
I think in this particular period, I would be about 10% as an overall portfolio. I would be 10 to 20% gold producers, not gold metal, but gold producers, because while gold will go up, the producers will go up more. And I would be 10% oil, but preferring the large producers and the commodity itself, which I think is going to rally a great deal in the coming months. I would go into smaller oil producers, like as soon as we see the end of the recession coming, then I would be going into smaller oil producers and gold developers as well as gold producers. I would also consider keeping some cash, but not all cash. But on the other hand, I would also consider the last financial crisis and the quantitative easing that happened and the low rates sparked the greatest general equity boom of our time. And those equities have still been completely beat up. I think if you're going for good quality gold, like blue chip equities, you might want to be buying, if you have the cash, you might want to be buying back into that right now because they're really at a bottom. I wouldn't be putting your money into fixed income because it's going to be a very long time before bonds are returning any yield whatsoever. And frankly, if you can remortgage at these rates, I think you should go for it as quickly as you can. But yeah, I think I would be, this is like the financial crisis all over again. And the financial crisis suggested that in order, going back into commodities slowly, as we start getting to the bottom of the financial crisis and start seeing our way out, is a great place to be because there's always a commodity boom in the year following a recession or a financial crisis. And in a financial crisis as well, where rates are really low and quantitative easing is in effect, gold is even more so a very important commodity. But it was also sparking the greatest general equity boom we've ever seen. And given how incredibly beat up blue chip equities are, I would consider buying some baskets of those equities back and trying to get as far away from fixed income as you possibly can right now.
Exactly. Okay. Amanda, thank you so much for your insight. That was really, really interesting and also very precious, I think, for all our viewers. So I hope you are going to keep well and keep us updated. Okay.
Sounds wonderful. Speak to you soon.
Thank you, Amanda. Bye-bye. So this is everything from the Financial Fox today, and I hope that this video was quite useful for you and it gave you some kind of guideline of how you should look at the commodity resource market. Start to put on your watch list some gold producers. Amanda gave her tips, and you can do your own research to get in as the market is recovering. Wait a little bit for gold developers and start to look at some bigger gold producers that have been eaten really hard by the low oil price. This is everything from today, and follow us and subscribe to our channel, and look forward to see you next in our future video.